Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of real-world assets. My name is Simon Taylor. I am your host for today, author at FinTech Brain Food and head of strategy over at Sardine. Joining me today is the most special guest I can imagine. Interviewing in person is the one and only Will Gaybrick, and you are president of product and business over at Stripe. How you doing, Will?
Doing great. Thanks for having me.
Really excited to have you. Of course, before we do get into the show, we're happy to remind you that this podcast is made possible by our good friends at Visa. And I do need to remind everybody that views and opinions are their own and might not reflect those of their companies, although I suspect that might be not always the case for everybody. All right, Will, let's get into this. Tell me the story of where you discover stablecoins personally and at Stripe, because I've heard podcast interviews with you before, people talking about stablecoins, and you were talking about them. So contextualize that and contextualize that to your day job.
Well, I think first heard about stablecoins relatively early. I think USDT on Bitcoin was something like 2014.
Yeah.
And I think a personal thesis I had, which I think is shared by a lot of people at Stripe and in general, was that eventually the killer app for crypto would be just money, and Bitcoin has served that pretty well from the standpoint of store value, but it's been more sort of financial asset as opposed to an actual sort of medium of exchange, and so that's why I sort of saw that happening with Tether all the way back then and thought, that's interesting. Bringing actual, fiat currency on chain and giving it sort of the superpowers that crypto has, and permissionless, performant now, programmable, maybe the one we think about the most at Stripe. And then we really started to get excited at Stripe was actually early 2020s. We started seeing the L2s taking off, and then just the writing was on the wall. Solana, getting wings, and once you could sort of see that the performance would asymptote to sort of where it is today, I think it'll get better and better. Where you can process transactions for less than a cent, and in less than a second, suddenly you've got just a better dollar, better euro, and so on.
You end up in this place where you're seeing a better dollar, a better euro, but you're also seeing the existing dollar and existing euro. So what are the problems with the fiat system that you see? Because I always thought that the superpower of Stripe was making payments work the way a developer thinks that they should work, but they actually don't. What are some of those gnarly problems that people deal with, and how do stablecoins actually solve those?
Yeah, well, maybe it's not surprising, but we think a lot about the future of money at Stripe. And, our mission is to increase the GDP of the internet. And, just from a mathematical standpoint, GDP is directly proportional to the velocity of money. So we've always been obsessed with just like how quickly we can get money to move. And so you sometimes hear stablecoins described as like digital dollars or digital euros or whatever. In fact, money has been pretty digital for a while. In fact, thanks to the sponsors, you noted, Visa, MasterCard, and others, they've really, done a great job of digitalizing funds. But the reason why I think that's a bit of a misnomer is it doesn't go far enough, right? It's digital programmable dollars, in an open ecosystem. And so, your balance at Barclays, for example, is already digital. But it's an entry in a database that developers don't have access to, is governed by sort of old code, probably in some mainframe somewhere. Not to pick on Barclays, just generally how banking infrastructure works. Suddenly you tokenize that asset, you bring it on chain, and you now have hordes of talented developers with this new stablecoin platform who can, make it move faster across borders, can give it all sorts of properties that you want to around, your balance goes this high. Maybe you want to stake it here because, you only need this much of it liquid and you want to earn higher yield on this front. Actually was thinking about this from the standpoint of applications that, we've seen built in fintech, the Acorns of the world, all of the asset management platforms. And all of that could be happening on chain, so much more quickly than, it has happened off chain, because you have to find a way to sort of yank this data out of banks and deal with all of the intricacies and, inconsistencies across them.
I think that inconsistencies thing is not something that can be adequately explained unless you've lived it. And I suspect Stripe engineers have lived it more than others. But you probably get this question a lot when people go, yeah, but I have instant and 24/7 now, and I can program payments now, and I can... have you given up trying to convince skeptics, or are you still very much of the view that enterprises are waking up and there's an education job to do here?
Yeah, I mean, look, we're kind of boring infrastructure guys to some extent, and so what sort of is most exciting to us is just at a base level, it's just a better technology, and you are. Chris Dixon has this line that I like. I think it was in his book. I can't remember, but been thinking it for a long time, which is that crypto solves not only technological problems but also political problems. And the political problems being, how can you get everybody to agree on things working a certain way? So you could say, hey, well, PIX or UPI have worked really well in Brazil and India. These are like broadly from a performance standpoint, better payment schemes than we have. In the U.S., lower cost, instant movement of the funds, and they're sort of universally adopted in those markets. But as soon as you go across border, you have literally these geopolitical problems. And I think if you were to say, hey, India, actually, we're going to go with PIX, so you guys need to rebase on that. I don't think you'd get a lot of uptake from other countries. And so having this, consistent, globally programmable platform just unlocks an incredible amount of potential. And its ability to sort of like exist a layer above all the localized schemes, allows developers to not even have to think about those.
Yeah, stablecoins are a platform has been a narrative I've been playing in FinTech Brain Food for a while, and I think it's one that's resonating with people because, India has tried to export UPI to many markets. Brazil has tried to export PIX to many markets, and it doesn't always fit where it doesn't have that local sort of acceptance. But there was this line that Patrick came out with, I think, right around the acquisition of this little company called Bridge. I don't know if you remember that. I want you to take me inside of that acquisition in a second, but this line is, stablecoins are room temperature superconductors for financial services. I'm still trying to unpack what that means. Did that make sense to you? Is that something you guys have used before?
Yeah, we've used it a bit internally, and I think maybe just so superconductors, incredibly high performant, broadly can conduct electrons with no resistance. The issue is you have to cool them, to extremely low temperatures, so they become sort of impractical from a daily use case standpoint. And I think what that line is getting at is that we're almost shocked by how performant stablecoins are. Like, who knew money could work this way? This is sort of amazing.
Well, you guys had some fairly big numbers in the last Stripe sessions. I think you overlaid the Stripe growth rate with stablecoin growth rate. Could you just take me inside what that is and what the genuine observation is? Because part of the management team at Stripe, you obviously signed off on this acquisition hoping it would do well. But what's been the surprise, and what have the numbers looked like?
Yeah, from the standpoint of the acquisition, we met the Bridge team maybe 18 months ago. And what we realized over time, in addition to just realizing that they were extremely good, was that our roadmap was pretty convergent, but that they seemed to be executing, at a pace that, could accelerate us. And they had, a really similar mindset around stablecoins as infrastructure. I think there's sort of two mental models. There's one, which is that, the fiat system and the sort of crypto stablecoin system will exist in parallel. And, that is not our belief. Our belief is that they'll be sort of deeply interwoven to move, in and out of each of them on an ongoing basis. And so, Bridge, their name is sort of that stitching between them. I think what we're seeing with them, so we showed a chart at Sessions, which is Stripe's hockey stick growth in the first 2 years of payments process. Then we overlaid Bridges, and Stripe's volume nearly disappears on the chart. And I think it highlights that, in this sort of familiar framework of, building products that are, medicine, not vitamin, we were building a better way to accept payments, and people needed to accept payments. And, back in 2011, it was a real pain point for developers, but you could get up and running. Bridge is helping entrepreneurs and developers solve problems that are otherwise just completely intractable. So they are, antibiotics in the late 1920s. They're sort of actual sort of newly discovered lifesavers, and you see that in the numbers, and it's just staggering.
I think what's fascinating to me about that is as I look at it from a strategy standpoint, people have now started to understand that it opens up markets that were not available before. Has it done that for you guys as well? Because I think there is no truly global payments company. I mean, as big as our sponsor Visa is, as big as Alipay is, they're all regional.
Yes.
Do stablecoins form a part of your desire to expand internationally?
Absolutely, yeah. There's maybe 3 examples that come to mind. First is we recently launched what we call stablecoin financial accounts. And these are sort of rolling out now, but will soon be supported in over 100 countries, at least 101 countries. There's sort of some questions of reverse solicitation, and as we can get into this, but stablecoin regulation still settling, but we feel confident in those 101. And these accounts just let you hold stablecoins, receive them from third parties, and pay them out, in fiat or in stablecoin balances. And actually, interesting story. As mentioned earlier, we think a lot about the future of money at Stripe. Leading up to sessions, we had this really lively, even heated debate about how to position the balances in those accounts. So, you're giving someone, in Argentina, maybe that's not the best example because stablecoins are so well known there, but, you're giving someone in, say, Guatemala, I don't know, just how well known they are there, a USD balance. And technically that USD balance is tokenized on a chain. And technically at launch for us, it's USDC. And there's a question of do you show the actual coin? Do you show the coin in the chain? Do you show digital dollars? Do you show just dollars? Because the end value prop to the holder of that balance is simply, I'm in USD and I want to be in USD. And so we eventually landed on showing the actual currency, but not the chain, in particular because our API sort of reveals the currency. So we figured, okay, it just should be consistent between the dashboard and the API. But this ability for Stripe to allow users to hold USDC balances across 101 countries, just it's something that would take us many years to get to otherwise.
Yeah, I can see that. You said one of the 3 products. Say the other 2, and then I have a follow-up on your point.
Sure, I'll go fast. Another, which I think you've talked about before on the show, is Visa cards to spend down stablecoin balances.
Yeah. I believe in 12 markets.
12 markets today, but that'll be growing quickly. We're just working on some of the compliance rollouts. And then the third one is stablecoin payouts. And just allowing platforms like X, creator platforms, to send funds to far more than 101 markets. I actually don't know the current count, but is far above that. And actually, maybe the last one, which we're seeing an increasing uptick of with digital services growing with AI companies, is accepting stablecoin pay-ins.
And that's what I want to double click on. And I do have a sort of a compliance jurisdictional question that I don't want to lose. But the sort of accepting stablecoin payments for AI companies, I think there was some chart you guys showed where 70-some-odd% of the big AI companies use Stripe by default. You're sort of indexed to Silicon Valley Mafia, so you tend to get the next big thing, which has played out really well for you guys. But that product might not be available to a lot of the global south unless there's some way to pay for that product.
Exactly. Yeah, and I think, I will say, we're sitting here in the UK. I'll say it's not just Silicon Valley Mafia. We've got, I was in Germany yesterday. We got DeepL in Germany for translation. Of course, 11 Labs here. We got Lovable in Stockholm. There's some big AI companies coming out of Europe, which I think is really exciting. And you're right. Actually, in fact, 78% of the Forbes AI 50 on Stripe, but actually that 78% is 100% of the companies accept online payments. So I feel very good about that penetration today. We want to keep it up. And as you note, these companies want to sell, ChatGPT or Claude or translation services to, every market in the world. So, DeepL, I was just mentioning, sells into over 200 countries and territories on Stripe. And that's supported actually pretty well today by cards and the 120, 130 odd payment methods on Stripe. The really promising thing about stablecoin pay-ins is that in a lot of these, emerging markets, even if they do have a way to pay today, they're also, consumers are commonly holding stablecoins and they're used to transacting in them.
Yeah.
And so they're very, happy to pay, for digital services in stablecoins. And in a lot of cases, that's not just faster, but also cheaper.
So that brings me to my jurisdictional question. Are you not concerned about, on some level, some local markets not wanting the dollarization of their economy? There are some markets that may be more pro that. There are other markets where that might be something they choose to fight against. I guess you can be sort of philosophical on that, but how much of a concern is that, and how much of a concern should it be?
I can't say I'm sort of the geopolitical expert to sort of have a really cogent answer on that, but I'll say, it does seem broadly like countries and sort of regions do care about their currencies, and there's a lot of countries that care to control their currencies. And so I think it will not be lost on them that putting currencies on chain changes things a lot. One thing that I've been thinking a lot about is digital euro, and I think the ECB is coming out with a digital euro. I guess Circle now has EURC. There is, some people actually are sort of claiming that a euro-backed stablecoin will be sort of structurally harder to build a business around than USDC or USDT because debt in Europe is not mutualized. There isn't an analog to the US Treasury. But broadly, just again zooming out to the technological sort of lens on it, these currencies should be on chain. They're just going to be more performant. They're going to move faster. They're going to move more cheaply. They're going to move 24/7. So I expect that.
There was a bank in Brazil that I think has started backing its bringing its deposit tokens on chain, so that you can do sort of on chain FX, and the beginnings of on chain FX are going towards the global south. So I suspect you may be right. It's a matter of time, and people will see the opportunity. Yeah. So I do think about also there's another acquisition you made, Privy, quite recently that you've announced, and I know there's probably some ways to go before that's fully closed. But talk to me about the Privy team and the role of wallets within this ecosystem. Where do you see that, what they do, fitting in the ecosystem?
Yeah, one way to think about where we are in the sort of evolution of stablecoins, obviously crypto more broadly, but stablecoins as a particular focus right here is, yes, we're early in the adoption curve, but also early in the product development curve. And you look at the boom in internet applications, after the likes of AWS sort of showed up and scaled. And the tools for developers to build crypto applications have been sort of subpar. They haven't lived up to the standards that
you expect in Web 2.
Exactly, yeah. So and that means that the consumer experience for these applications, is broadly, based in browser plugins, seed phrases, the types of things that consumers never want to think about and probably don't understand. And so just an essential part of the picture of building a great stablecoin-based application is wallets. And so we think Privy can really sort of be a coefficient, if not sort of an exponent, on the growth rates of stablecoin application development.
Yeah, it's self-hosted wallets are in particular interesting because you are then your own bank, but then there are some models in between that, and as a business, there are some economics that benefit as well.
And wallets are fascinating because the key part of the Privy thesis actually is they built a non-custodial wallet.
Yes,
meaning that they're actually on chain.
Yes. And so it's not held by somebody else on your behalf, the UX over the front. It's like you're holding that directly on chain, and Privy is just providing you the software to be able to manage that.
Exactly.
And to your point a moment ago, doing that with some of the wallets historically was like, using your elbows. It was a little...
Exactly. And being on chain is, actually... pretty important, and it creates some very deep questions. The other day I was actually talking to CFO of a very big and serious company, and he's very enthusiastic about the treasury utility of a stablecoin. So he operates, a ton of subsidiaries, a ton of different bank accounts, in a ton of different currencies, and really only wants a couple of major liquidity pools for his company. So now he's actually spun up on-chain wallets in each of those countries. There isn't actually a legal framework for who owns an on-chain wallet. Sort of ownership is just sort of by ownership of the private keys, so to speak. But he sort of, he and his compliance team have decided that, we're going to make sure that private keys are sort of segregated off and only officers of each of these subsidiaries have access to them. And so what was once a process of sort of slowly moving currencies, back to these central liquidity pools via the particular treasury routes required by this tax structure is just instantaneously moving money from crypto wallet to crypto wallet through the entities. And
which if you think about it like as cash that can teleport, then it starts to make a lot of sense. I could legally have piles of cash in dollars in all of those markets, and the problem was moving them around. I can legally move them through the banking system. The problem is moving them around. If somebody gives me this teleport button, that cash is a bearer instrument, but now I've got a teleport button that moves it anywhere I want. We had the chief revenue officer of dLocal on an episode recently. Apparently they've been doing that use case for the past 4 years because they had so many stocks of currency in different markets where it was building up that the treasury use case is one that people are waking up to, but some people have been quietly doing it for a while. But I was actually going to ask you, what are your thoughts on everyone issuing their own stablecoin? We saw headlines about Walmart and Amazon doing their own. Famously, Mercado Libre has had its own for a few years. Is this a rational thing, or are we just sort of in that nobody really knows, so you might as well hedge your bets phase?
Probably a bit of both. I think with major, technological shifts, they're sort of often overhyped in the near term and underhyped in the long term. You're probably seeing some of that right now. But I'd say my sort of pithiest framework would be if you were in the business of holding money on others' behalves, it probably makes sense for you to have your own stablecoin. If you are, a bank, for example, it probably does make sense for you to have your own stablecoin. I think for two reasons. One is you can improve your product by putting it on chain. Like if your product is, I hold money, I hold money for you on chain, and that money is better money. It can now sort of be moved more quickly.
Instantly and 24/7,
exactly.
Globally.
It can be staked, right? There's so many things that it can do. It can, we'll see how this plays out exactly, but I believe over time it'll be able to earn yield more effectively. A lot of money that's held in checking accounts today doesn't earn any yield, and so one of the things we've always been very excited about at Stripe is the sort of the potential for stablecoins to democratize not just access to USD and sort of major reserve currencies, but also to the risk-free rate. And so putting it on chain, make it a better product. And then two is consumers will increasingly sort of feel like they have their bank accounts, and maybe that sort of on-chain balances are a parallel bank account. And I think you may see a lot of shift from the bank account to the on-chain bank account if the actual sort of funds you're holding on behalf of consumers aren't on-chain themselves. So if you're holding funds, you should probably have your own stablecoin. It does introduce some interesting compliance questions I'm sure you've thought a lot about, which is if there's say JPMD, a sort of JPM dollar on chain, if that's an open loop stablecoin and it can sort of trade freely, then it's less well defined. Like, what does it mean to be a JPM depositor? Suddenly, these JPM stablecoins that sort of represent JPM balances will end up in hands that JPM probably doesn't want them to end up in. So there's some real question there of like, are they closed loop or open loop stablecoins? But surely I think they'll be on chain in some way. And then for the major retailers, one of the sort of early use cases that has worked well for crypto has been creating rewards programs. And a lot of major retailers want you sort of living with balances in their applications. Starbucks has done this famously well. I certainly think that if you were to say, hey, store money in Amazon or in Walmart, and by the way, at any time you can eject into USDC or otherwise in a completely liquid way, I think as a consumer, I'd probably be more willing to do that.
Yeah, the problem with the Starbucks ecosystem is it's closed, and it's also based on prepaid, which means you've got all of these costs that people don't think about in prepaid, like escheatment and just like, it's complex. And then, I mean, you were briefly CFO of Stripe, I believe. Then you've got to think about, is it an asset or a liability, and how do I account for all of this stuff? It's like actually really, really complex. So it's a difficult one to manage, and I think it's non-trivial.
I think the thing that this risks is us, as an ecosystem, sort of perpetuating some of the, sins of the present around extreme, fragmentation of payment methods, of payment schemes, and otherwise. We already have, sort of two dominant, USD-backed coins, USDT, USDC together, I think represent something like 99% of stablecoins, but now they're on a bunch of different chains.
Yeah.
And so you already have challenges where there's like insufficient liquidity between coins and chains. Then if you introduce, dozens of additional open loop coins, suddenly the combinatorics there get really, really bad. And I was sort of picturing in my mind, these sort of Stripe sessions of 2030, slide 1, here's the 200 payment methods we accept, and slide 2, here's the 200 stablecoins we accept.
Yeah.
And I think that's the world we don't want to be in.
Yeah, you recreate the maze.
Exactly.
I wonder, when is it a dollar? When is it a coin that's like represented as a dollar? And what's the difference between those two things is very difficult, because you're sort of asking consumers and businesses to think about the credit risk of the issuer and the utility of the coin in a way that they haven't had to before. It's a really fascinating challenge. But in that world where all of this is buildable as software and automated, like, what do I need Stripe for? Because you guys, like, what are you thinking about your role in the future?
Yeah, it's an interesting question, because you're seeing these two really interesting phenomena. We hit a phenomenon. We hit on one already, which is the proliferation of coins. The other is suddenly everyone wants to be the acceptance network for stablecoins. So
yes,
Visa has come out and said, we want to be the acceptance network for stablecoins. I guess Circle has just announced the Circle payment network.
Yeah.
We don't believe there should be an acceptance network for stablecoins. The state of the world today, where you have two very, very dominant networks. I want to give Visa and MasterCard and others a lot of credit, because they've built great products. We're very happy to be their partners. And yet, I think in a world where there was a bit more competition around how money moved, it would probably actually move more efficiently. I was thinking about
more velocity, which would grow the GDP of the internet.
Yeah, and even just, on the programmable point or the pluggable point, Bank of America, I think, or Bank America from Bank of America, I think it was 1958 when it was, first created. It wasn't until 1974 that disputes were introduced to the spec. And I think, probably anyone involved with any company thinking about credit card disputes and card disputes generally would say we haven't really gotten that right. That's not sort of part of the scheme that we're super proud of. And so you can imagine a world where, you have no monolithic sort of, choke points in how money moves, or, sort of clearinghouses and how money moves, that gives rise to a lot of unbundling of the sort of payments acceptance stack. So, one thought experiment that, we've done is, sort of go to sleep tonight, you wake up tomorrow, and instead of having, cards branded with, the small number of network names, your cards, are sort of NFC'd to, public key addresses on blockchains. And would the payments world be better or worse in that world? Maybe a lot of people in the crypto world, and maybe a lot of merchants who are frustrated by like high payments costs, would sort of jump to say like better, better, better. I think the answer is sort of in the immediate term worse, but probably eventually better.
Yeah.
And the eventually better is, you can allow for each part of the value chain. It's a pretty, thick value chain, with fraud mitigation, navigating disputes, of course, like, regulatory burden and everything like that, integration with banks. You can allow each of them to be sort of competed for, and sort of, you can make sure that the economics are accruing to, the parts of the stack that's sort of creating the most value. And so from our standpoint, we are not used to having sort of any sense of like networked market power. We're used to earning it on being, the best developer experience, the most reliable infrastructure, the most secure. And so as we look forward, thinking about, wallets, and wallets is a core part of developer infrastructure, Bridge, and stablecoins as a sort of core platform developers to build new financial experiences. We always get excited and we say, we're going to give developers great platforms and great tooling, and then they're going to surprise us by what they build.
Yeah, it's kind of, you can stay agnostic so long as that's the North Star.
Exactly.
It kind of gives you a lot of space to play and think a little bit differently. I'm interested what opportunities you see that you think people are not seeing or missing that we haven't discussed so far. What have I not asked you that I probably should have done?
Well, I think people really underestimate the programmability side of things. And I'm not saying you are, but it's there's the old the old Larry Lessig, code is law, sort of concept from 1999, where he's sort of saying, as the internet takes off, so much of how we live our lives and how our the incentives we receive, what we can and can't do, is going to live on these private servers, and it's going to be sequestered away from all of us, and we're going to be coerced and forbidden in all these different ways. And so we have to really start to take that very seriously. One of the super neat things about crypto is you can actually go read the law. So I was the other day, after Coinbase, Shopify, and Stripe announced, auth and capture for stablecoin pay-ins on Shopify.
Fascinating, by the way, as you think about, sorry to interrupt you, as you think about what the future of on-chain disputes look like and chargebacks, that was a really interesting model.
Absolutely. Yeah. And you can just go read the smart contract, 0xEDB. I don't remember what the address is, but, it's a 200 something lines of code, and you can read exactly how auth and capture are implemented. Mm-hmm. And the really cool thing about that is, if you don't like it, you can fork it. You could build it a different way, right? Yeah. And so, crypto as a sort of community has always had this ethos of, being its own sort of watchdog and sort of keeping an eye out for abuse of the crypto community. And lots of abuse around sort of speculation and tokens that are overpriced and so on. But there is also this ethos of it's kind of like an open source ethos of building it the right way, right? You think about, say, like optimistic rollups, like the construct there of, we're going to assume that all these transactions are correct, but we have validators and invalidators, and that's sort of,
and we create an economic incentive with game theory so that these mutually untrusting actors can come to consensus about the state of the network, which seems a very useful thing given the state of the world at the moment that may not have seemed useful maybe a decade ago, where surely the obvious answer was to centralize everything. And if we could just build the one centralized server to rule them all, then we'd solve all problems, which is kind of a zig and a zag.
Yeah. So I think we're given to believe from that centralization mindset that auth and capture is now solved in crypto, when I don't know, will it be tens, hundreds, thousands of different implementations of sort of scheme-like behaviors like that.
It's interesting. A friend of the show, Rob Haddock, has a line that stablecoins are collapsing and remaking the value chain of payments quite dramatically. So I do think it's simultaneously the most exciting time and the most threatening time. What have you learned in building products like billing, building some of the Radar, all of the other products that you think are lessons we should take in? Because I do think there's two types of people. There are people who say, oh, well, you've not got the experience I have in payments, therefore you don't know about all these problems, or stablecoins are just going to make everything. But actually, I think there are some day walkers in the middle. What is useful? What should we keep about the existing system?
I think one thing that's really interesting about crypto protocols is that they're stateful, right? And so you think about like HTTP or SMTP or a lot of the early internet protocols are not stateful. And as more and more just economic activity comes on chain, and as on-chain transactions are bigger part of payments, like risk management is going to have to sort of reinvent itself a bit. And so I think we're going to have to get really, really good at we'll see how verifying identity works, because privacy on chain, I think, is a big deal as well. But at least detecting bad actors. And I think we're seeing, on the AI side of things, that just vectorizing more features and looking at, sort of simpler models with less structure and higher dimensional spaces is very, very powerful. And so I think the idea that you've got so many transactions with so much data on chain, actually, I think in the long run, maybe means that it would be a lot better place to mitigate risk. But in the near term, I think there's a lot that we need to learn just as an ecosystem.
I think John Collison said it really well, which is like, stablecoins are like the Money 2020 conference of payments. There's a serious payments conference, but you got to walk through the casino to get to it. And I thought that was the perfect metaphor. And I get asked a lot, why did you join Sardine? And my hypothesis at the time was eventually the bottleneck is going to be compliance and fraud and risk. So why not go work with the guy who had to solve this at Coinbase, then at Revolut, and then elsewhere, because that will ultimately become the bottleneck. So I completely agree with you. And I guess you are operating a very large global regulated business. What are you guys doing to keep yourselves the right side of that as you as you look into the next couple of years?
Well, you mentioned that I was CFO of Stripe for a while. This is my first 4.5 years or so. And Robin Vince, CEO of BNY Mellon, was at that point, or during that tenure, the chief risk officer at Goldman Sachs. He's always been a friend and a bit of a mentor. I remember asking him when I was sort of ramping up on the job, what's most important for me as CFO, in particular at Stripe? And he said, Stripe must be conspicuously good at risk management. You must be known as being sort of conspicuously compliant, conspicuously good at risk management. And so that has been something that we've always taken really, really seriously. Mm-hmm. And so we're very enthusiastic about, a lot of the clarity that we're getting, with the Genius Act, maybe soon with
the Clarity Act as well.
Clarity Act, yes. We'll see. That one's a bit earlier on. And even just, clarity that MiCA's providing, whatever your stance on it is. It's almost like, the best answer is yes, the worst answer is no. The second worst answer is no, and the worst answer is maybe. And I think we're sort of finally getting the yeses and the nos, right? So we're thinking, a lot about that. But actually, back on the point of programmability, because you said billing, and it just put this beat in my head. Yesterday in Berlin, we launched open banking pay-ins.
Yes.
In Germany and in France.
TrueLayer, I believe.
With TrueLayer, exactly, yeah. A great company, Stripe portfolio company, and a really great team. And if you think about what's been holding back open banking, it is some like small missing abstractions, like VRP, like variable recurring payments, payments not being sort of implemented consistently across
the billing like features.
Exactly, the billing features, even just the ability to sort of like do a validation and then charge later. If VRP is missing on chain, any number of enterprise developers can just go build VRP.
Yeah.
And so this is where, the notion of a permissionless, programmable, and open protocol that, again, has solved the political challenge of just we're all going to build on this stack is so wildly powerful.
Fascinating. If we're coming up on time, so I do want to make sure that people have the opportunity to find out more about everything you're doing on stablecoins and more broadly. So is there a specific place you're sending them to for that? Is it just stripe.com/crypto or something? Or
stripe.com/crypto, bridge.xyz, privy.io. Maybe we should buy the .coms. But all over the place. And actually, we're going to be actually updating all of the pages on Stripe now, because as we get closer to this sort of like full stack for developers, like, the sort of crypto cloud can provide people with each layer in the value chain. We want to sort of solutionize that and make it more clear that Stripe can just be your sort of one-stop shop.
Stripe designers are going to Stripe design. Weirdly strong on that stuff. Well, I hope we have you back many more times, and also I hope we have many more folks on the podcast that you then go on to acquire. Is there anyone you'd like us to invite? Of course, I'm kidding. Well, it's been a real pleasure, Sam.
Pleasure. Thank you, Simon.